Hello, my name is Pushkar and I am here to represent my team group number 10. Today we are gathered here for our presentation on the book Value Investing and Behavioral Finance written by Sir Parag Parekh. This presentation consists of our key learnings and takeaways from this book, and the presentation will go in a linear way. To start with, I will be explaining the first two slides. First slide, please. If investing was just about math, why isn't every mathematician a billionaire? We are often taught that the stock market is this logical machine. But Parag Parikh's book, Value Investing and Behavioral Finance, argues the exact opposite. Sir suggests that the most important organ for an investor is actually the brain. It's not the stomach. It's not the brain, it's the stomach. It's about how much volatility you can handle without panicking. Let's focus on the core problem, our own nature. The first thing Parag Parikh sir hits on is that we are our own enemies. He talks about how 90% of our if he sir talks about how 90% of what we do is just old habits repeating themselves. We like to think we are being rational, but we are usually driven by what sir calls the cold traits: laziness, greed, and vanity. Sir makes a great point about EQ versus IQ. You can be the smartest person in the room, but if you don't have the emotional intelligence to stay calm when else is selling, your IQ doesn't matter. Success in the market isn't about being a genius, it's about being disciplined. Next slide, please. Now let's talk about the safe illusion. One of the most eye-opening parts of the book is where Sir challenges our idea of safety. In India, we are raised to love fixed deposits and gold. But Parekh Sir calls this safe illusion. Sir points out that while a bank deposit feels safe because the number doesn't go down, inflation is quietly eating your purchasing power every single year. Real risk isn't just the stock price dropping, it's the risk of not having money to live on 20 years from now because you are too safe to invest in equities. The double whammy strategy. So, how do we actually win? Parekh sir talks about the double whammy. This happens when you buy a solid company during a market panic. First, you win because the company itself is earning money and growing. But the second whammy comes when the rest of the market finally wakes up. When the crowd shifts from fear back to greed, the PE ratio jumps, and that's where the massive wealth is created. Sir uses the period between 1979 and 2007 as a prime example where Indian stocks delivered nearly 20% annual returns, dwarfing any safe investments. Last but not the least, the emotional way. Ultimately, the book's message is that you don't need to predict the future to make money. You just need to understand human behavior. Parikh's advice is simple but hard to follow. Ignore the noise, stop checking the ticker every 5 minutes, and let compounding do the heavy lifting. From now on, my teammate Chaitya will continue.
Hi, my name is Chaitya Gada and I'll be explaining the chapter 3 and 4 of this book. Let's start with behavioral finance. It explains how emotions and biases overcome and defeat financial decisions. For example, let's overtake first major challenge, irrational decision making, where investors let fear or greed override logic, leading to bad decisions such as buying high and selling low. Another is emotional discipline. Successful investing requires combining rational thinking with emotion control, which is often easier said than done. We also see common mistakes such as holding losing investment for too long or overreacting to short-term price movements. So this all connects to market inefficiency, which tells that in short run prices don't reflect their true value. So to overcome this, there comes a concept of strategic asset allocation. In strategic allocation, we have to diversify our assets into various asset classes such as equity, bond, commodity, etc. And we have to avoid an overexposure to any of these assets to immunize our portfolio. Next slide, please. Now I'll be talking about the investment styles and stock returns. There are basically two investment styles: value investing and growth investing. Value investing focus on finding stocks that are significantly undervalued and significantly trading below their intrinsic value. Analysts prefer such stock for strong fundamentals and they have a long-term outlook. Success in value investing comes from patience and discipline. Another is growth investing. Growth investor usually find stocks that have future high growth potential. They are offering to pay a premium in the price because they think that the rapid expansion in earnings will take place. This is often influenced by market sentiment. Stock returns are impacted by several factors. One of is that company's fundamentals, growth expectations, and as well as market sentiments. The return due to market sentiment is also called speculative return. The sentiment can be positive as well as negative. Negative market sentiment, despite of strong fundamentals, can cause negative stock returns. Next slide, please. I will be explaining what is contrarian investing. Contrarian investors usually do the opposite what majority of the crowd is doing. They buy when everyone is selling and they sell when everyone is buying. The main aim is to earn from mispricing created due to overheard and herding behavior. On the right hand side, there is a SWOT analysis of VST Industries from the year 2004 to 2007. At that time, the company had strong fundamentals, high ROE, strong cash flow. Despite of this solid strength, the company was trading at 52-week low, where the bull run of the market was happening. So, contrarian investor looked for this opportunity and bought the stock at cheap valuation and earned immense return, where for the next 3 years, the overall stock market gave negative returns. Next slide, please. Lastly, I will be explaining the challenges in contrarian investing. First is confirmation bias. Investors look only for the information they are seeking to confirm their belief. Second is recency bias. They usually focus on the most recent information rather than long-term trends. Myopic loss aversion. They are fear of short-term losses, and that leads to opposing of contrarian investing. Then comes herding behavior, where investors follow the huge crowd without any proper analysis. False consensus and group thinking also create pressure to follow majority of the public. And lastly, there are business and organizational constraints which create reputation risk and also create pressure to manage asset in a conventional way. So overall, to follow contrarian investing, you need strong discipline, patience, and independent thinking. Thank you.
Thank you, Chaitya. That was nicely explained. Hi, everyone. I'm Yash Nailwal, and I'll be taking you through the next slide of the presentation. And let me start with a very simple question. What constitutes stock returns? So when we invest in stocks, most people think that returns just come from one aspect, that is the capital appreciation. But actually, there are three aspects to the returns, which is first the capital appreciation, which is the stock price moving up. Since the business is growing good, the stock price usually follows. Second is the dividends. Dividends are what we receive by the company directly to our bank accounts, and it's usually not the main wealth creator of our. Third is the valuation, and it's the most ignored part, by the way. Even if the company is doing great, if you buy it at a very high price, your returns can be very poor. This brings me to the next example, where I'll be showing you a company which is also highlighted in the book, Infosys. And what I've done over here is plotted the revenue and the net profit data for the years 1994 to 2007, and similarly the stock price data. What we observe over here is that from the year 2000 to 2006, the revenue growth was 46.3% CAGR, and so was the net profit growth at 42.8% CAGR. But over this 6 years time frame, the share price barely moved and just gave a return of 5.13%. And if we just look at the 5 years time frame from 2000 to 2005, it was a negative return. So even though the business did everything right, investors didn't earn much because it was already filled in with the valuations the growth was already filled in at the year 2000. Now, next point is how do we avoid this growth trap? So there are four critical checkpoints for this. First is the management quality. That is, if the person running the business is not capable or trustworthy, nothing else matters. Second is the business sustainability. Whether this business, which we are seeing, is sustainable for the next 10 to 20 years, or is it just a short-term story? Third is the cash flow and the returns. So profits can be manipulated easily using accounting loopholes, but cash is the real king. So if the company is not converting its profit into cash, that's a big red flag. And fourth and the final part is the valuation that we just saw in the last slide. Now, that being said, let's shift our gears to the next part of the PPT, which is commodity investing. Firstly, commodity investing is very different from normal businesses. Commodity companies lack pricing power because the products are identical and its prices are determined by global supply and demand. Second, the earnings are cyclical. Profits just don't grow steadily, they move in cycles. Third is that timing becomes very important in these businesses because we are riding a cycle, which I'll be explaining in the next slide, by the way. Fourth is the very low cost advantage that some businesses have when there's a commodity downturn. And finally, patience is the king. Now, let me take you through a commodity cycle where I'll be explaining how to go about investing in commodities. At first, I've plotted dummy numbers over here to showcase a commodity cycle. This happens in a very long run, by the way. So in the time two, what happens is this is the bottom of the cycle, and the companies start making losses because of the unsold inventory that was bought at a higher valuation at T1. Because of this, debt start rising to fund their cash flows, and segment is very negative overall. The sentiment is very negative. So this is where most important investors panic, and this is where opportunities begin. Then comes the upcycle, where earnings rise sharply, debt reduces, and valuations of the company expand. And by the time everything looks great, the opportunity is usually gone. So in commodity investing, we don't just buy good companies; we see the bad timings of the cycle, and then we wait for the times to improve. So overall, whether it's stock or commodity, the key lesson is simple: that returns come from both fundamentals and valuation, and timing plays a huge role in it. On that note, I would like to pass it on to Shivan. Thank you.
So hey everyone, I am Shivanand Mahajan. I will be discussing the PSU sector, focusing on the reason for its slow growth and the positives that investors often overlook. To understand the PSU performance, we need to look at both structural barriers and investor behavior. PSU often face slow decision making because major investment require government approval, which delays expansion compared to private companies. Their limited presence in high growth sectors like IT and real estate also affects overall growth. Government ownership further creates uncertainty as investors worry about policy changes, pricing controls, and interference, which impacts confidence and valuation. In addition, many PSU businesses are commodity-based and cyclical in nature, meaning profits depend on economic conditions, leading to lower valuation compared to growth sectors. Apart from structural challenges, investor psychology also affect PSU valuation. Investors often assume PSU are inefficient and low growth due to government control, creating overconfidence and representative bias. Past bear markets and price control increased fear and loss aversion, while limited media coverage strengthened formation bias, leading to negative perception of PSU stock. Next slide, please. Despite these challenges, PSU sector fundamentals remain strong and provide long-term stability. Many PSU operate in industries like defense and oil and gas, but entry barriers are very high, ensuring stable market position and limited competition. Large part of PSU business are commodity-based, where technological obsolescence is low, and once capacity is built, companies can operate efficiently for long periods. PSU also possesses strong asset bases, including pipelines, refineries, and long-term government contracts, making it difficult for new competitors to enter and ensuring long-term stability. So if you look in this graph, there's an interesting study where 61 PSU companies from 1991 to 2006 shows that PSU performance varies across sectors. Here, PSU bands perform strongly with 10 out of 19 bands outperform the Sensex, while oil and gas underperform mainly due to government price control and oil bonds. Whereas fertilizer, paper, and telecom sectors decline due to deregulation and industry challenges. So to conclude, PSU stock appeared slow, mainly due to structural challenges and market perception, but strong entry barriers and valuable asset made them fundamentally sound. PSU performance should be judged based on sector and policy environment rather than general perception. Next slide will be explained by Slu.
Hello, my name is Shlok Gujarati. Slide name is Sector Investing, Top-Down Approach and Trends. Top-down investing is a very popular investing strategy. First, they identify a sector with strong future potential. Then they invest in a company within that sector, assuming all company will benefit from the sector growth. As more investors enter, demand increase and stock rising. However, this rise is often derived by hype and expectation, not actual fundamental. Behavior traits. Representativeness. Investors assume that if the sector is good, all companies in that sector are also good. Availability bias. Investor focus only on positive news and media hype. Herd mentality. People follow the crowd instead of thinking logically. Anchoring. Investor get stuck to the growth story and ignore company fundamental. Winner crush. Company overpaying competition. For example, Tata Steel acquired Cora Steel at a 49 premium over the market price, and two-third payment was made by debt financing. Confirmation bias. Investor only look for information that support their belief and ignore risks. Second slide, please. This slide explains how sector investing can lead to bubble formation. As we can see in the chat, the capital goods sector experienced a sharp rise in E ratio between 2006 and 2008, significantly outperforming the market. This rapid increase was not fully supported by fundamental and was derived by excessive optimism. Uh, Reliance Power IPO, where investor entered due to hype and high expectation, leading to overpay and poor return. In this IPO, investors were attracted by the Powering India theme and strong Reliance brand. Availability bias. Investors focus only on positive news, representativeness. They believe it will perform like other successful power company. Gray market premium manipulation. So high gray premium and false expectation of profit. A greater full theory. Investors believe they will sell at a higher price on listing day. This highlight an important lesson. Sector outperformance is often temporary, and investor must focus on valuation and fundamental rather than following market trends. The next slide will be explained by Mannan.
Thank you, Shlok. So every bull market births a new IPO wave. Companies go public, billions are raised, newspapers celebrate, and the retail investor queues up, convinced that they are going to buy the next big thing. But as Parag Parikh sir wrote in the book, that the markets are not driven by the numbers alone. They are driven by the human psychology. And nowhere in that psychology more ruthlessly exploited than in the IPO market. Here's the truth about the retail investor never considered that the IPO timing is never accidental. Promoters and the venture capitalists don't list their companies on a whim. They patiently wait for peak valuations, peak sentiments, and maximum investor optimism. And when the bull market hits the absolute peak, that is when they ring the bell. This is the issuer's strategic advantage, selling maximum equity at the maximum price to maximally optimistic buyers. Entirely rational for the sellers, but for the buyers, the story is very different. Now understand who is actually sitting across the table when you apply for the IPO. The promoter and the VCs are the informed sellers. They know the real revenue, the real risk, and the real ceiling of the business from where they are exiting. The investment bankers are hired specifically by the issuers to extract the highest possible price from the market. Their fiduciary duty is not towards you. And then there's the retail investor, emotional, hype driven, and deeply prone to the herd behavior. Oversubscription gets mistaken for quality, but oversubscription is a market outcome, which is engineered, not organic. High demand simply creates the illusion of value while masking the danger of the price being paid. This brings us to the second slide called the hot issue market illusion and is one of the most powerful psychological traps in all of the investing. So when an IPO is subscribed 50 or 100 times over, it triggers the social proof. If everyone wants it, it must be good. The rational brain switches off and the structurally what is actually happening is a transfer of wealth from uninformed retail buyers to the informed side. The promoter exit, the VC book returns, the banker collect the fees. And this is not a conspiracy. It is a structurally informed asymmetry monetized at a scale every single bull market cycle. And the history has experimented repeatedly with identical results. In the tech boom of 1999 to 2000, 79% of IPOs were technology companies. Retail investors pour in at the peak market euphoria. The outcome, 90% of those IPOs were eventually delisted or disappeared entirely. Billions in savings were gone. This then came the real estate boom of 2006 2007, where 16 construction companies raised 154.5 billion rupees. DLF alone raised 92 billion in the largest market IPO of all time. And in the bear aftermath of 2001 2002, between 13 to 38% of boom era companies delivered sustained negative long term returns, not temporarily volatile, permanent capital destruction. Three sectors, 3 decades, one conclusion. Peak optimism produced peak prices, and peak prices produce the worst long term returns. So, whenever your broker calls or your friends are applying for IPO, you just have to keep an eye on the market and keep the fundamental right. Now, Abhishek will talk about the index investing and the bubble trap.
Thank you. So now we'll understand what index investing is all about. So when it comes to the passive investing, index investing is the most priority which the investor gives. So we'll understand the characteristics of an index investing. First, it lacks leadership. So as we have stocks, there are no promoters or management for indexes, right? So they don't have the decision power for each and every stocks which the index hold. Second is the weightage is based on the market cap of the stocks. So this shows that the importance of the index is based on the market cap, and the market cap is based on the valuation which the investors pay for a particular stock. So the third point concludes that it has higher valuation. So why is market cap so crucial? So the best part of market cap is that promoters love having higher market cap because of their reputation. And because of this reputation, they're able to raise higher credit and raise funds at a cheaper valuation. And it is low risk as compared to the companies which have market cap. If return analysis, which was mentioned in the book, it took stocks of from 1979 to 2005, where all the stocks were taken into the consideration based on the market cap, whether it was incoming or outgoing, and the results were staggering. That the outgoing stocks gave almost 20 times the return of the invested capital, and the incoming stocks in the index gave just 8 times the returns. And the conclusion was that index investing is no better than the active investing. Then please. Yeah. Now comes the bubble trap. So what actually is a bubble? So bubble is basically exaggerated valuation and higher expectation. So basically it is a sale of a story with a higher optimism where the future gains are and probabilities are discounted in today's price. So there are three major characteristics of this bubble trap. First is IPO boom. Many companies come with their IPOs on board. Second is media hype. That is, media comes and create an illusion of growth for all the stocks. Third, PE is justified by the growth which what matters the most, which was given in the framework of Infosys. Like in 2005, the prices consolidated, even though the company was good, the returns gained by the shareholders was nullified. So as Sir Benjamin Graham says, price is what you pay and the value is what you get. So just to quote a fact, in the end, in conclusion, it would be that between the period of 2003 and 2009, GDP grew 6 to 9%, but the Sensex grew just 7 times. Over to over to Shruti. Thank you.
Thank you, Abhishek. Hello, everyone. I'm going to explain investor-based finance. This chapter begins with a very important question. Investors spend a lot of time researching companies, but do companies research the investors? The author says that it is important because stock price do not move only because of fundamentals. They move because of how investor interprets fundamentals. Traditional finance assumes that all the investors are rational and logical, like a simple equation of 1 plus 1 is equals to 2. But behavioral finance says that Real people do not always think rationally because emotions also affect the decision. So, in reality, the equation becomes 1 plus 1 plus emotion, which can be 2, 8, or even 50. This means investors are often influenced by emotions such as fear, grief, and optimism. Because of this, the stock price is not always a true reflection of a company's real worth. Instead, it just reflects investor perception. But why stock price even matter to a company? It's because a strong stock price helps to attract talent, raise capital, build market confidence, and even support mergers and acquisitions. But a weak stock price can create negative image and make getting credit difficult, which makes us to go to the next slide. That is the solution which the author states here. The second half of the chapter focuses on the solution. There is a corporate problem where management only focuses on employees, customers, and suppliers, but often ignore the investors. Author states that investors should be studies and also focused on. Hence, the shift is needed from what management wants to say to what investors wish to know. To solve this, investor mapping should be done. In simple words, management should think how important investors are, how they think and react, and predict their reaction to the business decision. This can be classified by two main two main things. By the investor time horizon, like short term, medium term, and long term. And secondly, by their focus, like organization watcher care about leadership and governance. Strategy follower focuses on the business model and growth plan. Financial addict focuses on the quarterly numbers and management watcher care about integrity and honesty. So the overall conclusion is that true wealth is created by those who choose the hard and necessary path. By recognizing our own reaction and emotions, one can become an investor which thinks rationally and let the other crowd be impulse. Thank you.